When the market crashes hard, what do? Your $100,000 drops to $60,000. Do you close the screen and sell everything? Here's the reality. That's the most expensive decision you can make. At minimum, the S&P 500 has ultimately recovered from every major decline in its history. And over time, it has gone on to reach new highs above the pre-crash levels. Take March 2009, near the S&P 500's lowest point. Invest $10,000 there with dividends reinvested, and by 2021, that becomes over $50,000. Today, let's look at those numbers together. Over the past 25 years, the S&P 500 has seen four major drawdowns. First, the dot-com bubble burst in 2000, a drop of roughly 49%. On a price basis, it took about 7 years to reclaim the highs. Then came the 2008 global financial crisis, a decline of approximately 57%. Yet by March 2013, the index had reclaimed its previous high. In 2020, COVID hit the market hard, a sharp drop of about 34%. But on a price basis, the recovery took just roughly 5 months. Then in 2022, aggressive rate hikes hammered markets, a decline of roughly 25%. By January 2024, about 2 years later, the S&P 500 hit new all-time highs. At least for the S&P 500, every one of these drawdowns was followed by a new high. That's the historical record. Now compare two investors at the March 2009 low. One sold at the bottom and held cash. They missed the entire recovery. The other stayed invested in the S&P 500. With dividends reinvested, that $10,000 grew to over $40,000 a decade later. Every investor experiences a drop in portfolio value, but if your long-term thesis hasn't changed, selling near the bottom tends to lock in your losses. That's the lesson history keeps teaching. So why can investing during a crash work in your favor? In normal times, one share costs $100. With $10,000, you buy 100 shares. Now the market crashes and the price falls to $50. The same $10,000 now buys 200 shares. When prices recover to $100, your original 100 shares are worth $10,000. But those 200 shares? $20,000. This is dollar cost averaging. By investing a fixed amount on a regular schedule, you lower your average cost per share over time. It doesn't guarantee a profit or protect against losses. Think of it as a long-term mechanism, not a sure thing. Here are 3 moves to make before the next crash hits. Number 1, build your emergency fund. Keep 6 months of living expenses in cash. A high-yield savings account is one place to consider. Just know that rates are variable. Always check current conditions. Number 2, keep investing. But this only works if the foundation is solid. Your emergency fund must be in place. Any high-interest debt must be under control. With that in order, consider continuing your $500 monthly investment within your means. Number 3, set aside extra capital. Keep $1,000 to $5,000 in reserve. A market crash can become a buying opportunity. Only those who prepare can turn a crash to their advantage. I hear it all the time. I'm too scared to start because of crashes. But look at the numbers. $500 a month, $6,000 a year. A 7% annual return, compounded annually, pre-tax for 30 years. The result, $566, $764. Keep in mind, that's a nominal figure. Your real purchasing power will depend on the inflation rate over that period. During downturns, you accumulate more shares, which can work in your favor when markets recover. That said, don't rely too heavily on a single index. Diversifying across regions and asset classes matters in the long run. No one can predict the market, but consistency, diversification, and low-cost investing, those are choices you can make. When the next crash comes, what will you do? Drop a comment and let me know your thinking. Whether you're prepared or just getting started, Let's keep building together. Thanks for investing your time with me today. This channel breaks down crashes, compounding, asset allocation, the mechanics of money, all in numbers. Every video delivers a clear, actionable path toward financial freedom. Hit subscribe and turn on notifications. The next piece of knowledge could be the weapon that protects your wealth. See you in the next one.